Hello everyone, welcome back to Strategize Finance. In today's video, we are going to review a few of the companies which have recently increased their dividends, see their recent performance, and check whether they are currently overvalued or undervalued. Let's check it out. And if you're new here, consider subscribing and hitting that bell so that you don't miss a single video packed with valuable information just like this one and help grow this young channel. The first company on our list is Procter Gamble, ticker symbol PG. Procter Gamble is a multinational consumer goods corporation that specializes in a wide range of personal health and consumer health and personal care and hygiene products. It owns many of the brands that we use in our day-to-day lives, like the Tide laundry products, or the Bounty paper towels, or the Pampers baby diapers, or the Crest and Oral-B oral care products. Procter Gamble, in my opinion, is one of the must-have stocks in a dividend investor portfolio. Procter Gamble recently raised its dividends by 5%, which is in line with its 5-year dividend growth rate of 5.37%. Procter Gamble has been growing its dividends for the last 65 years, so it's a dividend king, which is an exclusive group of companies who have been raising their dividends consistently for more than 50 years. Procter Gamble currently provides a yield of 2.18%. Year to date, it has fallen just 2.5%, which is much better than the market, which is down more than 7%. In the last 1 year, it has returned more than 16%. The last 5 years, 76%, and over the last 10 years, almost 139%. In the current high inflationary environment, companies like Procter & Gamble have a pricing power, which means they can pass on the costs that they incur onto the consumers by increasing the price of their products. And because the products they sell are mostly the products that we use in our day-to-day lives, even though the prices increase, consumers would not be having any problem in buying them. That's the power of consumer staple companies. And if you're as established as Procter & Gamble, then pricing power is one of the advantages such company has. The financials of this company look really good. Here we can see the gross profit increasing every year. Likewise, the operating income. Here we can see the dividends per share also growing nicely every year. Here we can see the free cash flow, even that is increasing very nicely every year. Track your dividends gives Procter & Gamble a dividend score of 78 and considers it undervalued by 11%. But as per my dividend theory calculations, which considers current dividend yield and the past 5-year dividend yield and also the future expected growth, I consider Procter & Gamble to be 20% overvalued with a fair price of $127. I agree Procter & Gamble is a great company to buy and have in one's portfolio, but surely not at current levels. So any good pullback in this company's share price should give one a good opportunity to buy into. The next company on our list is Constellation Brands, ticker symbol STZ. Constellation Brands is an American producer and marketer of beer, wine, and spirits. It owns the popular brands like Corona and Modelo. Constellation Brands has a market cap of almost 46.5 billion and it currently provides a yield of 1.29%. Year to date, it has fallen almost minus 1.6%, which is much better than the overall S&P market, which has fallen more than 7%. In the last 1 year, there is a return of 10%, and the last 5 years, 46.5%. In the last 10 years, more than 1,000%. Constellation Brands recently announced a dividend hike of 5%, which is actually much less than its 5-year growth rate of 13.7%. And the dividend growth has been just for the last 1 year. That's because, as we can see here, for the entirety of 2021, Constellation Brands had not increased their dividends. In fact, over the last 3 to 4 years, the dividend has almost stalled. When you look at the financials, the gross profit has been increasing every year. Even the operating income has been on a good upward trend. The dividend per share stalled for a while and then it's now higher. The free cash flow also was growing nicely higher, but here we see a small dip. Track your dividends gives Constellation Brands a score of 49 and considers it undervalued by 2.25%. But as per my own calculations, I consider Constellation Brands to be overvalued by 20% with a fair price of $200. So at the moment, I would stay away from the stock. The dividend increases have not been that great in the recent past. So it's more of a wait and watch kind of a company. So even if there is a good pullback, I might not be interested to invest into this company. The third company in our list is Bank OZK, ticker symbol OZK. This is a regional bank based out of Little Rock, Arkansas. It has a market cap of over $5 billion and currently provides a yield of of 3.06%. Year to date, OZK has been down almost 15%. The last 1 year, a return of just under 1%, and last 5 years, a return of less than 12%. In the last 5 years, a return of almost minus 12%. Bank OZK recently announced a dividend hike of 3.3%, which may sound very less, but Bank OZK increases its dividends every quarter by almost 3%. As we can see here, dividends rise every quarter. So collectively, on an annual basis, the dividend raise is almost 12%. It has been growing its dividends for the last 11 years. Looking at financials, the net income is rising slowly but surely every year, but the revenues are wobbly. Here we can see them growing up to 2019. Then in 2020, it took a big dip, and again we see a jump in 2021. Even the expenses are rising. The dividend per share, though, looks on a nice upward trend. Tracker Dividends gives Bank OZK a high rating of 93 and considers it overvalued by 5.3%. But as per my own dividend yield calculations, I found Bank OZK to be undervalued by just 4% with a fair value of $42. Overall, I feel Bank OZK is just a company for dividend seekers with a yield upwards of 3%. There's not real price appreciation from the stock. So if you're looking for a stable, ever increasing dividends, then go for it. Else can be ignored. The fourth company on our list is HB Fuller Company, ticker symbol FUL. HB Fuller is an American adhesives manufacturing company that supplies industrial adhesives worldwide. We can see here HB Fuller catering to multitude of industries like automotives, beauty, commercials, electronics, filtration systems, likewise. So it is well spread out. It has a market cap of $3.58 billion, providing a yield of 1.13%. HB Fuller announced a recent dividend hike of 13%, which is really good, and it is well above the current inflation of 8.5% and much higher than its own 5 year growth rate of 3.65%. It has been growing its dividends for the last 3 years. Year to date, it has fallen almost 15.5%. In the last 1 year, it's a return of 3.5%, and the last 5 years, a return of just over 31%. Looking at the financials, the gross profit was increasing till 2019. Then there was a dip in 2020, and again it recovered in 2021. The same trend can be seen here in operating income. The net income trend is not so great. It rises till 2018, then it dips in 2019 through 2020, then again rises by 2021. So it's all over the place. The cash flow looked very good till 2020. Then we see a big dip in 2021. Tracker Dividends gives HB Fuller a dividend score of 90 and considers it to be overvalued by 16.5%. As per my own dividend calculations, even I found HB Fuller to be overvalued by 16% with a fair value of $56. So though HB Fuller gave a dividend hike of 13%, I don't feel it's a company that great to invest into. The yield is low at just 1.13%, and returns have also been not great. So I would rather stay away from this company. The last company on our list is PNC Financial Services Group, ticker symbol PNC. PNC Financial Services is an American bank holding company and financial services corporation. It has a market cap of $77.29 billion and provides a yield of 3.26%. PNC recently announced a dividend hike of 20%, which is in line with its 5 year growth rate of 19%. Looking at the returns of this company recently, year to date, it has fallen almost 14%. In the last 1 year, it is down by just under 1%. And last 5 years, it has given a return of 55%. Looking at the financials, the net income has been rising nicely upwards. The revenues, though, took a beating in 2020, but then again recovered in 2021. Expenses have been consistently similar. The dividend per share has been growing nicely upward. Looking at the cash flows, even here we can see it taking a dip in 2020, then recovering back in 2021. Tracker Dividends gives PNC a dividend score of 80 and considers it overvalued by almost 12.5%. But as per my own dividend calculations, I found PNC to be currently fairly valued. It is undervalued by just 1% with a fair price of $182. So overall, PNC, just like Bank OZK, which we reviewed just a while back, seems to be like a company for dividend seekers with a dividend of over 3%. So though PNC has given a dividend hike of 20%, it's not really a great investment to jump into. There are better financial companies out there that give a nice growth. So currently at this point, I would not really say stay away from it, but there are better options out there. Out of all the companies that we reviewed today, only Procter Gamble is a company which I would like to have it in a portfolio, but not at current levels. I would like to see it dip by 20%. I'd like to see it below 130 to get into, and that would be an amazing investment. I hope you like this video and would really appreciate if you could hit that subscribe and like buttons. And also provide in the comment section what you liked about this video and what you would like to see any changes or any other topics that you want me to cover in the future. And I'll try my level best to do it. So until we meet in the next video, let's do as much as possible to be financially healthy. See you. Bye.